Let's start with this letter, which is a letter addressed to the Fed from three senators named in the screen, and essentially urging the Federal Reserve to cut interest rates by 75 basis points, and which was way above what not only the market was expecting prior to the cuts of interest rates of 0.5%, but also I think it speaks volumes to the sense of urgency that I would say most policymakers are facing with the fact that interest payments continue to rise to a degree that we're seeing now, and I do think that that's starting to really eat into the deficits in the government spending, and if we don't do anything about it, if we don't suppress rates, that is likely going to start affecting growth as well. That's just my opinion. And what is interesting as well is if you look throughout history, all the way back to the 90s, the only times we've seen cuts that are more than 50 basis points on the Fed funds rate were actually associated or very close to recessions, leading to a recession, actually. In the 1994 or so, that period during the mid-90s that a lot of people like to refer to as a potential era, that didn't lead to a recession. We only saw actually 25 basis points rate cuts, but maybe I'll have more on that research later. If you look at the long-term inflation expectation, to me, what is interesting of what's happening currently is the fact that inflation expectations, in my view, which in this case is measured by the break-even interest rate, as Kevin was saying, this is just a measurement of expectations by the market, by where CPI rates will be in 10 years from now, whatever duration you're looking at break-even rates. You can see that on the monthly chart, the monthly candle chart, you can see that we're actually looking at a line that used to be a resistance that now turned into a support. And this is interesting because first we had, remember back in 2020 when gold was surging and nobody knew why, or a lot of people are associating that with money printing or the expansion of the monetary base and so forth. And then later on, we all sort of clicked and said, oh, it makes sense that gold was surging. It was because inflation, those are people basically predicting that inflation was likely to see a resurgence. And I think this is precisely what's happening today. It's very similar setup. Gold prices have been leading the way to the upside, but we're yet to see some other things that tend to actually move when inflation starts to move to the upside, especially not only expectations, but my view, cyclical commodities are likely to have a move as well. And so go back to energy. Energy is an interesting market because, as you can see here, we're showing two panels in this chart. The first one is looking at energy equities in yellow. So that's the XLE ETF. So that's just a proxy for the S&P 500 energy sector. And you can see that there's a divergence here all the way back to 2022 with oil. Oil is in green. And that divergence really started when oil peaked, right when the Russian invasion actually period really happened. The peak of those concerns in markets, not in what's happening in the war itself, but in markets really peaked at that level. And then we've seen a divergence between the two. That weakness in oil markets, it's not really shared in the energy equity space, as you can see here. There has been a lot of resilience, and you can measure that by looking at the ratio of those two lines in the second panel of this chart, where even when oil was declining, energy stocks were actually still doing quite well. And that resilience, in my view, just really tells me to at least gives me conviction that this is probably the beginning of a trend on energy, not the end of one. And so I'm paying close attention to energy because I do think there is a likelihood of the resurgence of actually inflation being linked to energy prices appreciating as well. And if you look at the positioning in oil, looking at the CFTC positioning on how many of those contracts are long WTI oil futures, and you can see we're at one of the lowest levels in for the last decade or plus. as you can see here. And so basically positioning is really off balance. So and I think that adds to the conviction as well that we could see things turning or seeing a turning point in those energy commodities too. Not only oil itself, but I think natural gas could also play a role there as well. And if you see oil a little, take a step back and look at quarterly candles of oil itself, you can see clearly that we've been sort of bumping into this for some time now. The same way oil and the break-even rates, or again, inflation expectation or CPI expectation, they're actually fairly close. They're very close types of charts, and those lines look very similar. In other words, it's hard to see times when break-even rates are rising, but WTI oil prices or Brent prices are not rising as well. They're usually linked to each other. And you can see the similar kind of trend here where we broke out in 2020, 2021 on the oil prices. And then we've been kind of, seeing this consolidation period above that trend. And I think that, this is another positive, development in the energy space as well. Another thing that is, when you think about cyclical commodities that could benefit from a resurgence of inflation, the other thing that comes to my mind is copper, because copper tends to be very cyclical. And you can see that copper actually in gold, although people like to always point out to the cyclicality of copper itself and oil, especially when you have a recession, you can notice the actual link between metal prices, gold and copper, throughout history. And what is interesting about this chart as well, if you go back to the mid 90s or so, a lot of times actually the gold movement tends to lead, especially on movements to the upside, not the downside. You can see that gold actually tends to lead those movements. In other words, it tends to move first, and then copper prices will move later. And so you can see in the mid 90s, we saw that. So gold was actually moving higher. Then later on, we did see copper prices starting to move as well. You can see the same happen in the early 2000s. Gold started to move higher, and then later on, copper began to move. And the same is happened in 2015. Gold was moving way ahead of copper during that time, I should say. That was 2018, I should say. And then after the COVID recession, when the copper actually collapsed, as you can see there in that green arrow, then copper really began to have its upside later. And so today, when you see this divergence between gold actually making new highs recently, and at the same time copper actually being copper not too long ago was the flavor of the day, if you recall. That was, and this is what is interesting about commodities. When you tend to be in this sort of bull market in the commodities space, when you have this big cycles in commodities, they tend to be very interconnected. In other words, when one commodity starts to move, they kind of go through cycles. And I think I pointed this out in prior presentations, but, what was the flavor of the day, 3 months ago? That was copper. Copper was surging not too long ago, and now it's gold. And not too long ago was orange juice, and you had sugar, lumber prices, nat gas had its day. And now it's basically in the dumps. And so you kind of can see these rotations that happen within the commodity cycle, which I think are another very kind of a classic behavior of being in a more of a bull market stage. Nonetheless, you can also look at the 10-year yield, because if you're of the belief that inflation expectations could be bottoming out, along with break-evens, along with CPI, along with all sorts of things that you can measure in inflation, then that should also create some upward pressure, all else equal, on the 10-year yield in the U.S. And so that 10-year yield in the U.S., if you looked at throughout the last decade or two, you can see that we've been in, every time we've been in very oversold. So there's two panels in this chart. The second panel is looking at the RSI, which basically measures when any security or asset is oversold or overbought. Usually below 30 means you're oversold. And so you want to pay attention, or above 70 means you're overbought. you want to pay attention to those periods, because although you may have a view that a market is on a secular trend or something along those lines, you can still have corrections along the way. And I think the 10-year yield is sort of in that classic way as well. I mean, it's if you step back and think about a few years from now, at least the view here is that there is a potential that the 10-year yield could be a lot higher. But markets, they take their time to make those movements. And we've had a big downward move, as pointed out by the RSI. The RSI is sub 30 right now on the 14-week measurement. And as you can see, I pointed out, highlighted many other periods in which we had that also that oversold on the 10-year yield, which means that the Treasury bond, it was actually overbought, because they have an inverse relationship, interest rates and the price of the bond. And so you can see clearly here that there were some really big turning points. Not all of them turned out to be major turning points, but some of them were. And I think one of them that was very interesting is 2016. And it's not a political view at all, but you can see that during elections in 2016, that was a turning point where the 10-year was also very oversold. And then on the back of that, we had a large movement to the upside. I think that's a very intriguing scenario that could potentially play out today. Now, if you think about the 2-year yield, which we've had a view about, 2-year yields potentially falling and so forth, they did have a very large movement, as you can see, measured by the RSI as well. Same calculation. You can see that the RSI, but this one I'm doing a 9-day RSI, or 9-week RSI, even though it says day. You can clearly see that these bottoms are also marked by the chart as well when things get really oversold on the yield basis. And so, now in this measurement, we're not on 30, we're actually on 20. So that's also an interesting setup for some level of consolidation of the 2-year yield, which makes me believe, goes back to the yield curve inversion idea. If you think about the yield curve inversion thesis that we've had, which it's been that we are going to be steepening the yield curve. The 10-year yield hasn't really been forcing this uninversion process. What's been forcing that has been the 2-year yield. Now, if you ask me, I think that now I would give a higher weight of probabilities that the long end of the curve is going to be forcing the uninversion process of the yield curve. And so I'm paying close attention to this. And this measurement here in this chart that you're looking at, it's a calculation that we created that basically looks at all the possible spreads in the yield curve. And when you have these spreads, going above 70%, which I call the threshold in that case, every time we've seen a recession, and this time we haven't seen a recession yet. So this is the first time it's been delayed a little bit on the recession front. However, notice that when these white line, when it starts to actually decline after hitting the threshold, it has some really abrupt turns. And so, which gives us conviction that this uninverting process of the yield curve, in other words, that the potential for the decline of the white line in this chart is also highly likely. So it's very interesting macro setup for this. And now let's talk about something else that adds to that case, because if you're the view that maybe we're going to see more steepening on the yield curve, in other words, that potentially the longer end of the curve or the higher duration of interest rates could have a larger move to the upside versus the ones that have a shorter duration. One thing that comes to mind was what created this thesis in the first place, which was the over issuance of treasuries. And one thing that I haven't seen anybody really notice has been in the middle part of the treasury market, the notes. So you have the T-bills, the notes, and you obviously have the bonds that are the longer ones, the 10 years above. But the notes have been showing a phenomenon that I don't think has been pointed out by many people, or in fact, I haven't heard anybody talk about it. But you can see the last month, we've seen the largest issuance of notes almost in the history of this instrument. And you can see that we're going back to a large number of years here, or 2 decades, basically. And these things didn't used to be tracked back in the day. So I'm not really cutting out the chart just for the reason because it's really because there is no data going back much further. But as you can see here, the type of phenomena that we tend to see, the surge of issuances in notes, tends to happen also during recessions or during that 21 coming out of the recession of the COVID and the pandemic issues that we had. All these things really cause the fiscal spending to also increase the issuance of treasuries, in which for a moment we've had a kind of a pause on this issuances. And now, as you can see, we're kind of seeing another wave of issuances more recently on the notes front. This is also happening on the T-bills. I don't have a chart on that on this one, but it's another aspect that should be pointed out. If we go to another thing that I think is highly inflationary that needs to be emphasized is the Baltic Dry Index. And this is, I pointed out the first wave of inflation, and is this the potential for the second wave of inflation could be driven as well by this the how broken up things are on the logistics standpoint. So what is the Baltic Dry Index? Is really helping you to have a notion of the cost of shipping goods worldwide. And so if that cost is rising, you see that green line rising as well. So that's highly inflationary. And I would say particularly if you're a large importer of goods and services, which is the case with the US, particularly goods. Goods is the largest percentage of the trade balance when you break that down. So good imports is a very significant aspect of why we're also with the US is also running a twin deficit here. And so that's an important aspect. Now, all these things have, in my view, could have a big impact on the currency front, because as you tend to see not only a twin deficit, running a twin deficit, but also this inconsistency of interest rates by the Federal Reserve, but actually not being able to, by actually having causing the interest payment issue relative to GDP being extremely high. As I said earlier, 70% of the deficit today, 70% of the U.S. deficit, government deficit, is being used just to pay down debt. And so you have to think about it's starting to really eat up to how much government spending is allocated towards growth, and which to me has been one of the main factors in the U.S. That caused growth has been this fiscal exceptionalism that we've had over since the global financial crisis really has been more prominent. But if we're going to see this inconsistency of rates versus fiscal policy being readjusted, in other words, interest rates in the U.S. having to be suppressed or likely suppressed in order to address this overspending on the interest payments, then I view this as a potential as well to have an impact in the currency markets. And one thing that is, to me, very much outside of the consensus view is that the dollar could actually weaken relative to other fiat currencies. I think we've made our case over and over again about the hard assets aspect, but also it's very important to point out what's been happening with fiat currencies like the Australian dollar. And when you look at this chart, where we've also seen historically many times where this line has served as a resistance for prices. And now recently we've had a beginning of potential that could be a major breakout, historically speaking. And if that's the case, a lot of things can be unleashed because of these trends. When the dollar weakens, you can see hard assets actually strengthening. You can see emerging markets doing much better. And I think that gold can be very beneficiary for precious metals themselves and miners and energy and so forth. And so this is why, to me, I'm paying close attention to this chart as well. And the positioning as part of the for being sort of a out of consensus view reflects that very much so. And you can see this Canadian dollar positioning remains one of the most extreme bearish positionings that we've had over the last decades. And so it's important to be aware of that off balance positioning as well on the Canadian dollar. I was talking about Australian dollar before, but Canadian dollar looks very similar. In fact, I would even go further to say that the Canadian dollar is lagging some of these other currencies. And if this is a real movement, I would suspect that the Canadian dollar would follow along as well and do the same type of breakout. These are just my views. But for the purposes of also understanding the gold space, the metals and mining space, one thing that is important, and I think Quentin would hopefully add more to that view too, is when you're looking at this open pit projects and so forth, one aspect that is very important for these projects is the energy cost. Energy cost plays a big role into making these projects more profitable because energy cost becomes a larger percentage of the cost profile of these mines. And as you can see here in this chart, one phenomenon that has been happening on the macro side is that metals have been outperforming oil for some time now. Now, I noticed I said earlier, or bullishness on the energy space. However, being bullish on energy doesn't necessarily make you bearish on the mining space. In fact, the gold to oil ratio, if you step back to the early 2000s, during that period when gold stocks did very well, during the early 2000s all the way to 2011 or so, the gold to oil ratio also was not really rising, was actually falling. In other words, energy was appreciating or outperforming metals at that time. So the opposite of what you're looking at right now. And despite that, we still saw gold stocks doing very well. So it's not, at the end of the day, this is not the critical factor that makes gold stocks fundamentally improve, but it's something that adds to that. And you should be aware of it, especially at times when there is overly skepticism towards this industry, which we've presented here many times, that has been our view at least. And you can see here, this could add quite significantly to the improvement of the bottom line of some of these mines worldwide. And then you look at the gold miners, which is also remarkable. The gold miners have been sort of hitting this support line, or I should say this resistance line, for some time now. And again, remember, I just showed the many charts that also show this kind of downward trend, and where you're kind of hitting in that downward trend, and all of a sudden you just break and it create momentum on a very different and shifts the whole trend from a downward trend to the upper trend. And you can start seeing these things usually, technically speaking, when you start forming first a major bottom, and then that is then followed by higher lows, and which is kind of classic of what's happening with the gold miners. If you look at Philadelphia Stock Exchange Gold and Silver Index, if you look at GDX, if you look at GDXJ, so there's a lot of proxies you could use to see that the higher lows pattern, technically speaking, has been very well established in the gold mining industry. And when you chart gold along with that, you can see that gold, while a lot of people think, or at least have been trying to explain the lag of the miners versus gold, saying that, gold can rise and miners will never follow. No, historically speaking, which I think we can only use history in our favor for this. Nobody knows the future, but history does help to kind of find a potential roadmap for asset classes and how they potentially could behave. And you can see clearly that gold prices have been way ahead of the miners here, but potentially could be actually just signaling that what is yet ahead of us is further appreciation for the gold miners. And so that gets me excited, because I do think that our thesis is strengthening on the back of the white line, which is gold prices. I mean, matter of fact, gold miners, what do they sell? They sell gold. If gold prices rise, what you would expect that should have at least shouldn't be a negative impact, should be actually a positive impact. So but markets have been difficult, and there's a few types of headaches that we've had over the years. There's migraine, there's hypertension, there's stress, and there's investing in gold miners. So I think we follow that bottom right side of it, and I think that's the painful moment is just it's part of the game. But the focus on the thesis, focus on the big picture is always important. Jokes aside. And one thing that has been reflecting this bearishness is this chart too. I mean, a lot of people look at this chart. There's two types of investors, generally speaking. There's a lot more types of investors, but generally speaking, there's two types of very important investors. The ones that look at this and say, oh crap, this is terrible. This is a disaster. I'm not going to even go there. I mean, what the heck? Is this a structural problem in this industry? And there are others that draw lines like this and say, wow, is this likely forming a bottom? And you can see that the decline of this chart, the downward trend that we had, clearly shown in this chart, that I think the yellow line also helps to see that kind of declining trend. You can see that since 2015 or so, we've been going sideways on that. And so, it makes me think that, these bottoms, they're not large bottoms. When you have like these big structural declines, large bottoms, they don't form all of a sudden. They really take time, especially because it hurts investors' mentality and forms so many opinions. I mean, think about this. Think how many people form opinions about the mining industry just by looking at this chart. I mean, majority of people in the market don't even want to touch gold stocks because of this chart. And so, it takes conviction. It takes a lot of work to understand and have an opinion about where fundamentally these companies could potentially be. And I view this as a very much a legacy industry that could potentially be on the very forefront of a secular upside movement, given what gold prices could do 5-10 years from now. And so if we are in that environment where gold enters a gold secular movement, this could be actually a big change in this chart in particular that could look quite the opposite 5-10 years from now. So to me, this is a big focus on why I like the miners so much. And another aspect, I was just looking at one chart that I worked on years ago, looking at the global production of gold, in which, in the 70s, early 2000s, we've had, two similar trends. Was that when gold production was falling, actually we were in a very very strong bull market. Perversely, that was positive for the miners, believe it or not. The fact that they were not producing a lot, although they held gold reserves and some of them had high quality assets, others have bad quality assets and so forth, but they still actually perversely also had a very strong decade during that period relative to other decades. And so what is interesting about this today, and this is not picking on Barrick itself. I mean, you can see this across the industry, but this is the second largest gold miner in the industry. And so it's remarkable that we're seeing this, this downward trend, lowest gold production in over 20 years. And, the fact that a lot of these miners have been, kind of shifting away from gold focus into copper and other things. And as we see that transition, I think that that's also quite positive for the gold space, because supply-wise, another aspect, S&P Global put out a great research showing the breakdown of CapEx. So breaking down CapEx, development per CapEx versus sustaining CapEx. So how much you spend to sustain a mine that you have versus how much you're developing things to become a mine one day. And guess what? The sustaining CapEx doesn't really change throughout the years. What you spend usually doesn't really change, more generally speaking. And that is very well reflected in the chart. The problem is that the other side of it, the development side of it, has been actually shrinking. In other words, we're not seeing the new development of mines in the copper space, in the gold space, and all sorts of metals, silver space, and so it's really interesting that on the back of those, you tend to see actually very positive trends. And the 1970s is arguably one of the best periods to look back and remember how the lack of discoveries, the lack of exploration budget really, set the stage to a long-term bull market at that time. And we think that there's a lot of similarities with that today as well. Last thing I want to point out is what's been happening, just a measurement that I did by looking at the cash flow margins by sector. And I used the gold companies, which are not a sector, but I added the gold companies here, the precious metals industry. I looked at all the companies that have over $1 billion in market cap in the Canadian and US exchange. And you can see that their cash flow margins is actually significantly better than other sectors, even like technology, that have a cash flow margin of 27% or so. This chart is just one way to kind of see that fundamentally we are seeing lots of improvements in the gold space, and not only that, but also relative to other industries and sectors. And to me, that's really what adds to the case. And at some point, you start seeing investors becoming more open-minded to those improvements, and potentially changing their views and allocating more capital to the space, creating those big changes, those downward movements becoming now upper movements at some point.